how do we interpret these global bond yield moved race to the bottom?
I think the reason that the attention that we're paying is more to the bond market than the equity market at this point is because the central bankers have gotten out in front a bit. We haven't seen major economies falling into recession yet. The U.S. looks like it's still, I think, pretty far from recession. We think it's only about a 1 in 3 chance over the next year, and you need to see the trade war escalate in order for that to become a big risk. But because you have central bankers cutting rates, last week we were talking about the Fed, maybe, why are they cutting rates? Is this a preemptive measure?
Now it looks like they should have done 50.
Now it looks like they should have done 50. And the problem is, looking at the probabilities, if the Fed just delivers on what the market's expecting, it's not going to have an impact. Even the announcement effect of additional rate cuts at this point is not going to be helpful. So do they come out with a surprise? Do they come out intra-meeting? Do they go 50 in September? I think these things all have to be on the table if they want this to have an impact. And the tweets this morning from the president make their job a bit harder because it looks like any measure that they do, extraordinary measure that they do, is coming because of political pressure.
Or targeting the dollar, which they also say they do not like to do.
Right.
I mean, why else would they go 50 and surprise the market?
Just to basically to assuage investors to that we're not here letting you kind of invest without a net here, that we're not going to let the economy fall into recession. But I think they do have to give some lip service to the reason we are doing this is because of the uncertainty that is being created by trade, not just the sort of mathematical damage from the tax increases themselves, but the uncertainty that we're creating down the road for lack of investment and potentially in the third quarter now lack of consumer spending.
Burns, what are you guys doing at Allianz and within your portfolios on a day like this where we see such a dramatic move lower in global bond yields?
Well, there's obviously no place to hide within equities on a day like this. And this is a continuation of what we've seen for quite some time of these binary markets where you basically have either monetary policy or trade policy or what are steering the markets right and left. And to some degree, you have stocks moving so much together that it makes it harder and harder to find companies that are trading on their own fundamentals. I think that a lot of the defensive sectors have been bid up to the point where if you go to defensives, well, you're paying so much for that insurance that it loses a lot of its defensive nature. And so I think probably one of the first places we're suggesting investors look and that we're going into are both dividend payers and really specifically companies that are growing their dividends. Dividend-paying names tend to be a little bit less volatile than the market, and they do offer stability in this type of situation. And just look for company-specific stories. Places like, for example, the defense sector is one place that investors might look, where you do have that stability, but they haven't been bid up to the same degree that consumer staples or even utilities have.
Are you surprised that small caps and/or companies that rely largely on the domestic economy here, Burns, have not fared better in this downturn?
Typically, and we saw this a couple of years ago, that when we saw that a lot of the slowdown was being brought from outside. It was coming from a slowdown in the global economy, whereas the U.S. economy is still doing very well. You do have low unemployment, you do have high consumer confidence, and in that environment, you would expect smaller caps to be doing a lot better. But at the same time, you also have a tightening of global financial conditions despite the efforts of central bankers. And oftentimes small caps are some of the names that are the most vulnerable in those instances.
Brian, what are you telling investors to do, where to hide?
Pretty similar to Burns, looking at more defensive names, looking to get income because we don't think at this point that the market's likely to move higher in the near term. We're not going to wake up and have the trade war solved anytime soon, it looks like. So, collect income where you can. We'll probably come out of this with some interesting opportunities in the credit markets as well once things settle down.
Where in the credit markets?
So we've been de-risking within high yield, even within investment grade. That was the right call coming into this period. But coming out of this, assuming the markets die down a bit, assuming the volatility comes down, that's been a pretty good time in the past instances of these trade-related disruptions in the markets to come into somewhat lower rated credit as sort of a tactical move.
When you hear people like Larry Summers talking about odds of recession going up, that's the first place you look, right, is in the credit market. It doesn't feel like we've seen too many signs of stress.
The high yield spreads have come out. They came out pretty aggressively in a very short period of time. They were a little bit more well-behaved yesterday. They're going to be correlated to what the equity markets do. I expect they're going to be widening out today, too. So we're still looking for a bottom in terms of the high yield market.